Welcome, and you're watching Closing Trades here on ET Now. I'm Harsh Saita, with me is Snehisha, and let's go across. We have with us Devin Choksi at this hour, Managing Director, DR Choksi FinServ. Devin, firstly, it's a very good day to have you. Secondly, thank you so much for waiting very patiently while we come to you, because there's just so much happening. But Devin, let me start off by trying to understand, is this nervousness that is building up, especially with regard to the way the street is reacting, is it overdone in your opinion, or is it warranted and justified? Are we in maybe a few months of uncertainty till we understand what the impact or the full impact of AI could well be?
Hi Harsh, good afternoon.
Very good afternoon.
Thank you for having me on the show. Well, my understanding on the subject is, I think, a little bit more deeper as far as the education on the various IT industries business model. On one side, I think AI solved a huge amount of problems in form of, I think, building the complete understanding of the subject before it becomes, I think, a software. So to a greater extent, I think this is where most of the Indian IT companies' business model is positioned today. Earlier days, suppose if they took some months to arrive at, I think, the basic understanding before they start coding and providing a software, today I think they could job in minutes. And that's where probably I think the bigger game plan is unfolding in my viewpoint. The coding part of the requirement, providing the software to the use, I think is not going away anywhere. And I think that will not go away anywhere, even after the AI, largely because of the fact that I think AI is only an enabler to this activity. And AI may be an enabler to coding, AI may be an enabler to, I think, business analysis. But ultimately, finally, to run the activity on a day-to-day basis, creating the agents, I think that would be driven primarily by the software. That is what we are all understanding. And Indian IT companies are actually speaking, I think, have positioned themselves very well into this new model. If they were up till now charging to their clients on a time and cost basis, today they are charging their clients on an outcome basis. And client is more than happy to pay the companies on an outcome basis, largely because of the fact that I think these companies, by adopting AI, have started saving time. If the agility-based development was the rule until yesterday, today AI-based development is the new rule, and which their clients take it. And that's where probably I think these companies are saving cost to client on one end, delivering faster solutions to them on the other end. So if this model is transitioning from time and cost to outcome-based revenue-making proposition, in my viewpoint, I think many of the Indian IT companies are likely to get larger business orders, because I think the business environment is changing very, very rapidly. Most of the companies, the existing companies, I think might also have to invest, I think, for their survival, if not anything else. So in my viewpoint and point, maybe I think if you were to take an example like Bajaj Finance in Indian domain, is a classic example wherein I think they are scoring using the AI into their forefront. They're scoring the significant amount of business. So, well, I think maybe market will soon get some amount of reality. Maybe some analysts, I think, will find out deeper meaning of how AI is actually used by most of the IT companies. And so-called carnage, which has happened into the stock price of companies, probably, I think, the right understanding will probably, I think, help them in overcoming into this particular nervous situation. So I'm of the view that the things are not looking as bad as it is sounding. On the contrary, I think for most of the IT companies, it's a new birth, new business, new environment in which they will be probably flourishing in coming times.
Okay, so that's quite the optimistic outlook on IT. Devin, hi, good afternoon. And it seems like this outlook is also being shared by the street, because you are seeing a massive recovery on Nifty IT from the day's lows, about 1,300 points higher from the day's low. Talk to us if you're seeing this as sense prevailing once again in the market, or do you see this as simply investors buying the dip that we've seen in so many days? And if that is something you would recommend at all, where would you go shopping within IT?
Well, yes, absolutely saying this is the time when people are shopping full manner, because my understanding, as I explained, I think this fall in the stock prices is not taking away the opportunity, it is making opportunity far bigger. And if India has to integrate itself into the free trade agreement of the world, which we have signed, probably I think some of these companies are going to see some massive amount of business environment emerging for them. It may not get reflected in an instant gratification manner in the market immediately, but I believe that I think people who understand the businesses, they would possibly, I think, start accumulating some of the good quality stocks because the valuations have really become cheap. Not to forget few things, the large companies like Infosys, TCS, and even meter IT companies which are providing the solutions in a typical embedded environment space. I would think that I think these companies are basically, I think, giving you the entry opportunity at a corrected valuations. Because of, I think, the ability to survive in this
Okay.
environment far better than what I think one may imagine. So maybe, I guess, I think this is a good opportunity. Some of the larger companies, they have better handle at this point of time to manage this entire subject. They have the cash position in their balance sheet. They have the ability to change, to complete the change over mechanism. So I would think that I think concentrate on them. Downside risk over there may be limited. At the same time, I think upside may be gradual because I think they're large. So I think upside may be slightly gradual, but that's okay. You're getting at corrected valuations.
Absolutely. Devin, outside IT as well, the carnage is, to a large extent across the board. I mean, metals lead the pack today, at least in terms of the cuts we're seeing. And I know that you don't talk about daily movements, but it's starting to look better overall as well. I'm not so sure why FMCG should be down 1.6% on a day like this. It just makes very little sense. It seems like it's more of a knock-on effect, and therefore, are some other sectors also looking good? And if so, what are you buying? For example, realty is down 2.5% as well.
Well, I think to my understanding, this is more technical at this point of time because when the IT fell, probably I think along with the index weight, I think had to be adjusted to other stocks. So out of no choice, I think some of the index trading funds actually started, I think, from doing the weight balancing. And that's where probably I think you see the carnage happening in some other areas, which is not warranted. Frankly, I think those companies are fundamentally sound. I think many of the names which you are probably alluded to, they are fundamentally sounding sound to me at this point of time. And I believe that I think this is probably a beginning of a very good time for next 4 to 6 quarters in many of the businesses. See, I think FMCG, since you mentioned, we have been looking at it. I think the kind of opening up of the economies which is taking place for the trade purpose, some of these FMCG companies will find their legs into the global markets. Today, in general, I think 5% of the business of FMCG company comes out of the exports. We see a possibility with European Union alone, a possibility of, I think, at least 15 to 20% kind of an export business coming eventually into their books. So frankly, that export business could be possibly at a better margin, frankly, because I think if India has to be a sourcing point, those countries probably, I think, are finding meaningful entry point into India with the products which are 30 to 50% cheaper in some of the cases. So in my viewpoint, I think FMCG companies should be looked at favorably and not otherwise. This could be possibly, as I said, technical reason, wherein probably some of the heavyweights have come down because of the index balancing, weight balancing. And probably I think that could be the opportunity also for some long-term investor as I see it.
Okay. Thanks so much, Devin, for joining us with your perspective, and good to be chatting with you today. Thanks so much for your time.
Thank you.
Okay, we were shifting focus to a corporate conversation then. Let's get into a conversation with the management of Biocon. We have Mr. Siddharth Mittal, the CEO of the company, joining us. On the back of their earnings, EBITDA margin largely in line with estimates, but other than that, it's a tad bit of a miss versus the estimates on revenue, EBITDA and PAT. So why has this happened? And more importantly, what is the outlook going ahead? Let's understand this from the management themselves. Mr. Siddharth, hi, good afternoon. Thanks for your time today. With 10 formulations and 9 API DMFs filed, when do you expect meaningful commercialization benefits?
See, all depends on when the patent expires, when our customers get the approval, and when, if it's a formulation, when we get the approval. So, typically, as you know, the development cycle ranges anywhere between 2 to 3 years, and then the review cycle tends to be between 1 to 2 years. And then the commercialization starts, if it's a launch upon approval product, then you will get the benefit, let's say, in a 1 to 2 years time. And if it's a later launch product, then of course, depending on the date of patent expiration, the commercialization benefit would start.
And in biologics, Tech has gained strong traction. What is the current market share and where do you see this share grow to in coming years?
See, it's already high single digit, low double digit, and it continues to be the number one biosimilar product in the US. And I think in a very short span of time, we have seen that market share inch up. And I think, as we have alluded to in the past, we've got also a very, very robust formulary coverage in the US, which covers almost 70% of the lives. And of course, unlike a typical generic drug where the penetration is quick, in biosimilars, the penetration to a good market share can take between 1 to 2 years. And I think, as I mentioned, that since the launch, our product has been listed on most formularies. We have got a decent market share and it's growing. And I think I won't want to necessarily comment that where it could reach, but I think we are very confident that over a period of time, we will continue to be in a lead position and market share will continue to build on.
Okay, and also help us understand what is the peak revenue share potential expected from Tech, if you could share any numbers on that front?
See, again, it all depends on number of players and what kind of pricing strategy that each player has. But when you look at the brand, it's still a very, very robust $8-9 billion brand. I think we definitely think that this can contribute meaningfully in terms of the revenue. We have 4 products which is already contributing over $200 million plus in annualized revenues globally. And over a period of time, we definitely expect that this could be the 5th product in that family, which can contribute significantly in terms of absolute revenues and the revenue growth in the coming quarters.
Okay, and India participation of semaglutide will see increased traction next month onwards. How are you positioned in this market?
See, India is a very different market because India is the only market which requires clinical trial. We have an approval to start our phase 3 clinical trial. We had divested our India formulation business to Eris 2 years back. And so we will look at bringing this drug either through a partner over a period of time by either conducting a trial or once we receive an approval in one of the ICH countries, then seeking for a clinical waiver. But, there have been other approvals in India and we do expect these companies to launch the product very soon. And India is going to be very competitive market. So we'll have to really assess that whether it's worth or is there an economical sense in conducting a clinical trial because the competition is going to be so heavy and the price expectation for the drug in India is significantly lower compared to pricing expectation in the other parts of the world.
Okay, Mr. Mittal, on that note, we'll let you go. Thanks so much for your time. So viewers, that was the management of Biocon. But shifting focus, just very quickly taking a look at what the market is doing, and we're absolutely at the day's lowest point. In fact, we're 1 or 2 points higher from the day's low. So we're as good as the day's low right now. 25,500 on the index, a 1.25% cut coming in. And now we're 300 points lower on the index. So yes, almost a fresh new low for the day. It's Hindalco, Eternal, HUL, ONGC, Adani Enterprises and Coal India that lead the cuts. And we've seen some stellar recovery in the IT names, but that has had no impact at all on the broader benchmark. On that note, time to slip into a very short break. We'll be right back with more on the other side.
We have with us Siddharth Khemka, Head of Retail Research at MOSL, and Kunal Bothra, as always. Kunal, let me come to you. Siddharth, great having you. After a very long time, we're chatting. But Kunal, let me come to you with regard to the market. The morning was dominated by weakness in IT, and that is what was spilling over on the index. Now we've seen the IT index recover, but we've seen some of the other sectors start to weaken and weaken very, very sharply. What do you make of this and what's playing out?
Yeah, it's a little intriguing to watch because, the falls on the back of, the IT index going to a correction. And we've seen the correction being a little bit more on the intense side in the last 8-10 days, almost like a 20% cut for the IT index and a 20-25% kind of a cut for individual stocks, large caps and mid caps within the IT pack. But again, the mixture of the markets today indicate that the large cap names likes of Reliance, ICICI Bank, HDFC Bank, etc. These are the kind of stocks which have taken a turn for themselves on the downside. Again, I think what's interesting is to see is that names like Reliance, etc., they've managed to break their 200 DMAs after today's price action move. So which means that we could be looking at a point where the markets would just about wait for these large cap stocks in case if there's any kind of a further sell-off. The only shining light over here is that the Nifty is holding on to 25,500 mark. That's been the huge support for the index in the last 7 days. Even last week or so, we managed to retest 25,500 mark, and from there we bounced off. So that's the only positive aspect. But the concern is that the large cap names like Reliance, HDFC Bank, etc., if the stock starts to show signs of further weakness, then maybe the support could be breached on the downside.
Okay, so that's the market on the technical and that take on Reliance. But Siddharth, hi, good afternoon. Good to be chatting with you. Talk to us about how you are seeing this subduedness that we've been seeing for back-to-back days in the market now. What could be the reason? Because like Harsh mentioned, IT today has recovered, but there is an overall sense of negativity in the market. Amid a market like this, would your approach be to wait and watch, or are you looking at buying the dip? And if so, where would you be placing your bets?
Yeah, good afternoon to all of you. I think if you look at the market construct, we are at the fag end of the Q3 result season. And what we have seen is that the result season more or less have been in line with our expectations. There have been a few misses, but largely a lot of companies, they have reported in line to better than expectation numbers. Key overhang for Indian equity markets was the US-India trade deal, which now seems to have been almost ironed out. The actual signing of the deal is yet to happen, but I think that changes the FI perspective on Indian equities to a large extent. So what we expect is going forward confluence of several factors which should construct positively for the Indian markets. The India-US trade deal having been ironed out, so the overhang of FI selling, that should go away. The earnings bottoming out and recovering from here on, that should also help, especially given that the third factor, which is that market has been consolidating for the last 18 months. And we have seen that now valuations are at par or marginally below the 10-year average on a 1-year forward basis. So all this put together, we believe that while for the next few quarters, Indian market should gradually see an uptake and give a return of about anywhere between 15-20%. The challenges do remain from the global front. We get a lot of news flows. The US interest rate, I think that becomes a key factor. We had heard the announcement of the new Fed chair and the market reacting negatively to that. Again, we saw some of the macro numbers coming in on the US side. That is a key factor. Plus, I think the geopolitical issues that keeps erupting in between once in a while. And finally, the latest is the AI-led disruption that creating volatility in some of the segments of the equity market. I think that intermittent volatility cannot be ruled out in the near term.
Okay, on that note, viewers, time to slip into a very short break. We'll keep the conversation going on the other side, so stay tuned.
Firstly, wishing you a very, very happy birthday, Gurmeet, and it's great having you here on your very special day. So thank you for that. Thank you for taking out time. Gurmeet, also, it's a difficult day of trade, right? And your perspective obviously helps on a day like this. So give us a sense. What are you making of this entire AI trade which is at play? And what's the kind of impact that you see on Indian markets? Of course, IT, but outside of IT as well, because there's carnage across the board.
Yeah. No, so I think as far as AI disruption is concerned, I think it is real. I don't think so there is any two ways about it. But I think the kind of impact we are extrapolating and in a very short period of time is something, I think we'll only come to know when time passes. I was listening to Mr. Vishal Sikka also on this, and he made some pertinent points. One of the point he made that, the driverless driving came 20 years back, and adoption is still less than 1%. So one is the tech, the tech disruption. Second is the adaptability, the adoption of it, which takes time. Organizations are very large, complex, have different cultures, And you can't simply just, and I think at some point of time, there'll be a bit of a trade-off between the GCC as well as, the Indian IT offshore agencies. And I think our companies will also adapt and make it. So nobody's talking about the opportunity AI presents. Everybody's only talking about the disruption it presents. And happens, I think also the fact that sentiment is low, but I think the good thing, Harsh, is that a lot of things are turning around. And I think the market is not right now showing enough, recognizing them. For example, look at the bank credit growth, that's 14-15%. It's come back after a very long time. The F3 supply, which is the money supply in the system, which is currency, deposits, money market, that's up 12%. Power demand is surging. Corporate earnings, if you see, are out of 450 odd companies have reported numbers from 500, BSE 500. The revenue growth is more than 12%. And adjusted for labor cost, the earning growth is 15-20%. Especially mid and small, the earnings have been pretty good. So I think things are from an economic point of view, improving. I think from a market point of view will probably happen over a period of time.
Gurmeet, I'm going to have to cut this conversation very, very short because unfortunately here, or fortunately here on the Times Network, we are doing the Global Business Summit and we have Tuhin Kanta Pandey, who is the chairman of SEBI, who's speaking. Let's go across to him.
Will guide our approach. The nature of challenges may evolve, but disruption itself may remain a constant. We therefore need markets that are resilient by design, capable of navigating geofragmentation, technological shifts, and other emerging risks, while continuing to support growth and innovation. This is a context in which we speak of India's next regulatory frontier. Regulation can no longer be only reactive. It must become anticipatory. It must move with markets, not behind them. Today, I will draw your attention to recent developments in SEBI's capital market regulation and our endeavor for optimum regulation as we negotiate the emerging challenges. India's capital markets are transforming at an unprecedented pace. Household savings are increasingly finding their way into capital markets. Capital market participation has expanded at a scale we could not have imagined a decade ago. We now have 140 million unique investors. This is financialization in action. Market capitalization has grown more than fourfold in the last 10 years to over 470 trillion rupees today. As a share of GDP, it has risen from around 81% in FY 2015 to 138% today. This is not just growth in numbers. It's a structural shift in how the economy is financed. Capital raising in our market has also seen strong momentum. In FY25, equity and debt issuances together amounted to 14.3 trillion rupees. In FY26 so far, from April to January, an additional 11.6 trillion rupees has already been mobilized, which included capital raising through 329 IPOs. In 2025, India led in IPO activity globally with record number of IPOs and stood third in terms of IPO proceeds. Mutual funds have become a major channel for household participation. Assets under management had grown from around 9% of GDP in 2015 to about 23% today. SIP assets now represent nearly 20% of total mutual fund assets. The ownership structure of listed companies is changing. Individuals and mutual funds together now own around 21% of listed entities, compared to 13% in FY15. This means the Indian household is no longer a peripheral participant. It's now central to the equity story of India. But growth also brings new risks. More participants mean more responsibility. More innovation means more complexity. This is where regulation must evolve. Regulation itself has changed with the market. We are moving from a framework that focused largely on entities to one that focuses on their activities and risks. We are moving from silo oversight to a more coordinated regulatory architecture. We are also moving from static rules to dynamic supervision. The role of regulator is not limited to regulations. It's about being a market developer, a guardian of integrity, and a protector of investors. Regulatory consistency and proportionality matter. They are not constraints on growth. They are enablers of confidence. As markets scale, the quality of regulation becomes as important as the quantity of capital they attract. Let me now turn to some of the key reforms that are shaping this next phase of market development. These reforms are not about fixing yesterday's problems alone. They are about preparing for tomorrow's markets. To support India's expanding economic aspirations, we are building deeper and more diverse markets. Indian securities market is the first major market to implement T+1 settlement cycle. This reduction in settlement cycle has resulted in reduced risk, faster access to capital, and improved operational efficiency in the market. Our market microstructure allows for granular client-level visibility as compared to omnibus structure in many advanced markets. Our depositories are handling over 210 million demat accounts, while exchanges process around 40 million trades in a day in cash market segments. To facilitate capital raising, we have simplified listing frameworks, reduced listing timelines, and proposed easing of minimum public offer thresholds for large issuers. SEBI has taken several steps to strengthen the corporate bond market. Introduction of electronic bond book provider platform led to increased efficiency and better price discovery in primary market. The request for quote and online bond platform providers are helping improved price discovery in secondary market. Further, RBI and SEBI are looking forward to introducing a framework for derivatives on corporate bond indices, which will further deepen the corporate bond market. To bridge the gap between mutual funds and portfolio management services, we have introduced the Specialized Investment Fund. For foreign investors, the Swagat FI framework now offers easier access through unified registration, simplified documentation, and streamlined compliance. We are working towards paperless and digital signed workflows to improve FPI onboarding experience. Reforms in the block deal framework and the introduction of the common contract note for institutional trades will bring greater clarity and consistency to large transactions. The decision to introduce closing auction session in the equity cash segment is another major step. It ensures that the closing price reflects collective market consensus. It also enables passive funds to transact at the closing price, helping reduce the tracking error. A market deepens only when supply and demand grow together. We have revised the distributor incentive structures to encourage onboarding of first-time investors from beyond top 30 cities and to enlarge participation of women investors in mutual funds. To improve retail access, the minimum investment threshold in privately placed bonds has been reduced. Moreover, issuers can now offer incentives in public issues of debt securities. To promote ease of doing business, we have streamlined IPO processes and created a single filing system to reduce duplication. Related party transaction disclosures have also been simplified. Flexibility has been introduced in BRSR core, allowing listed companies to opt for assessment or assurance. Comprehensive reviews of key regulations covering mutual funds and stockbrokers have been undertaken to make them more coherent and contemporary, while the review of LODR and settlement regulations is ongoing. We have implemented several reforms aiming at ease of business to promote alternative investment fund segment. We are also looking at the ease of exit too in addressing some practical difficulties. Investor protection is not a separate pillar. It's embedded in everything we do. We have introduced validated UPI handles and the SEBI check tool to help investors verify intermediary bank accounts to prevent cyber frauds. The Unified Investor app provides a single view of holdings across depositories and simplifies e-voting. The Mitra platform helps track inactive mutual fund folios and improve KYC accuracy. We have also launched a unique initiative called Parva to ensure that performance claims by intermediaries in future can be presented to investors in a verified and standardized manner by a third party. To further facilitate the investors to get rightful access to their securities, recently we have opened a special window for transfer and dematerialization of physical securities. We propose to considerably ease the process of transmission of shares as inheritance. To protect the interest of investors who pledge their securities, we have proposed to strengthen the pledge framework through depositories. To further ease investor onboarding, we have also proposed to streamline KYC processes further by enabling centralization and portability of supplementary information at KRAs. Additionally, we are aiming to strengthen the risk management within the KRA framework by introducing defined timelines for periodic review of KYC records. These steps may appear operational, but collectively they build trust. And trust is the true infrastructure of markets. As participation widens, governance standards must rise. Recognizing this, we have taken several measures to strengthen governance and accountability across the ecosystem. SEBI has designated the compliance officer as a key managerial personnel, reinforcing accountability at the highest operational levels. Boards of listed companies are being nudged from ceremonial oversight to active stewardship. We have also taken steps to enhance transparency and quality of disclosures. Disclosures in price band advertisements for public issues have been strengthened, and we are introducing an abridged prospectus at the draft offer stage to improve information accessibility for investors. We have mandated that regulated entities dissociate from unregulated entities that make unverified claims on returns or performance. Growth is welcome, but growth anchored in governance is what sustains confidence over the long run. Technology is reshaping markets faster than any rule book can. Algorithmic trading, digital platforms, and AI-driven decision-making are now part of everyday market functioning. We are responding through SupTech, which is supervisory technologies, and RegTech, which is regulatory technologies, stronger cybersecurity frameworks, and improved data governance. We have set up a high-level expert working group to develop a short-term and long-term strategic technology roadmap for the securities market ecosystem. AI offers powerful tools for surveillance and fraud detection as well, but it also brings risks, opacity, bias, and concentration of technological power. Regulation must therefore evolve from supervising institutions to supervising systems and technology. We must address concentration and interconnectedness risks, strengthen data governance and consent architecture, and manage the boundary between regulated finance and unregulated digital spaces. We are not on this journey alone. Regulation is a co-created ecosystem where the regulator sets direction and guardrails after due consultations. Industry innovates responsibly. Market institutions carry trust. And parliamentary and judicial oversight, accountants and auditors, media and civil society strengthen accountability. I urge you to work with us in shaping an ecosystem that can meet the demands of today and the uncertainties of tomorrow. Thank you.
Okay, what we'll do is slip into a very short break and then take the last lap of markets, last 15 minutes for the day, for the week. Markets under pressure. Let's quickly take stock of what's playing out. Stay with us. Weakness to sustain, because where we are currently, we're at the day's low. So it's not even like we're seeing any sign of a recovery.
Yeah, so no recovery, I think, throughout the day. And, it started off with the IT stocks first initially selling off. And then within the, first, I think, half an hour, first hour or so of the market open, you actually saw many of the other large cap stocks start to take, a knock for themselves. So that generally is not a positive sign, because, when you see market breadth deteriorating, and one of the sectors which was the major reasons why the markets had sold off, those sectors start to see revival, but the other sectors start to contribute on the downside. That generally indicates that the structure is getting a little bit on the weaker side for the markets. The bigger aspect when you look at on the technical front is the Nifty now holding below 25,500 levels, which looks like that we should be closing below 25,500 mark. That I think could probably just about increase the weakness for the indices over the near term. So my expectation is that mostly I think from next week onwards, you would probably expect the index to go into a further round of a correction. The intensity of the correction would probably depend on how the global markets shape up. But yeah, I think the break of 25,500 mark sort of confirms that.
Okay, got it. Kunal, some names that are big laggards today. One, Muthoot Finance, about 11.5% cut now on that one. And Eternal from the Nifty 50 group of stocks is also lower by about 4.5%. Would this now be a good time to buy either of these names?
So I would avoid, because what happens is with such kind of a sharp sell-off in names like Muthoot Finance, it would probably indicate that the stock has not formed a bottom, and the bottom could be sometime away for the stock price. It's not even broken the previous support for itself. So there's this major support at 3,400 for Muthoot Finance. My expectation is that in this leg of price correction, the stock could break past below those levels of 3,400. So we need to wait for that to happen. For Eternal also, I think what's happened is, as I was pointing out earlier, that with the sell-off today, many of these stocks have fallen back below their long-term moving averages. Same is the case with Eternal, the stock breaking below the 200 DMA. That level was around 290 mark for the stock price. So till the time it trades below 290, there is a strong possibility that this downward pressure may continue for the stock.
Plenty of pharma names also under pressure. Kunal, let me come to that actually in a minute. But Muthoot Finance, Mithali here to tell us as to what's keeping the stock under pressure.
Right, we saw that the stock has been trading in red since morning, even after delivering a blockbuster set of numbers for Q3. The company delivered an exceptional quarter, and mainly that was aided by a sharp rise in the gold prices. The net interest income for Q3, it surged nearly 64% on an yearly basis. While if you talk about the profit after tax, there is saw a surge of around 95% on a yearly basis. Also, the asset under management, it grew strongly as well, rising 51% year on year. But why is the stock tanking even after delivering such strong set of numbers? Let's have a look at that. So markets, they appear to be focusing on emerging concerns rather than the headline growth for the company. Customer count has declined by 1% quarter on quarter from 6.57 million in Q2 to 6.53 million in Q3. Also, the gold holdings, which are measured in tonnage, also saw a sequential degrowth for this quarter, falling to 205 tons in Q3 from 209 tons in Q2. Also, this signals moderation in their underlying volume growth. And another overhang, it remains the gold price volatility. While higher gold prices, they boosted the loan values this quarter, but earnings remain highly sensitive to any correction or maybe stagnation in the gold prices. Competition in the gold loan segment, there also we are seeing intensifying competition, which could pressure the yields and also the margins going ahead for the company. In the con call, management also pointed out that the new borrowers who earlier preferred the unsecured loans are now shifting towards the gold loans. Now, if you talk about the valuations for the company, they also remain quite expensive. The stock is trading at 4.1 times its price to book, with forward PB at 3.3 times 1 year and 2.8 times 2 year forward. While if you talk about their earnings front, it trades at 16.7 times trailing earnings, with forward PE of 17.4 times. So in summary, while the earnings growth, we saw a robust growth there for Q3, but investors, they are seeming to be concerned about the slowing customer additions, also the tonnage contractions, gold price risks, rising competitions, and also premium valuation for the stock.
Thanks so much for taking us through that. Moving away from that, Kunal, we have about 4 minutes for the markets to wrap for the day and for the week. And the big question that I'm sure all our viewers have on their mind is what to do. Is this fall going to continue on Monday or for the rest of next week? Is that something you're seeing? Or do you believe that this was just a little bit of a drop in the market, a temporary one-off, and we're looking at recovery?
No, I think the fall should continue for the index next week. I'm not sure whether it will happen on Monday immediately, but I believe that the effect of the sell-off which has happened in the last 3 days for the indices should have ramifications over the next 1 week going forward. Because I think what we're doing is, in the last 10 odd days, there have been 3 major gaps which have been created on the charts. The first gap was, of course, on the US, India-US trade deal. The second was on the EU trade deal. And then the third one, which happened on the gap downside, is what we've seen today on the back of IT sell-off. Now, when you have such kind of a strong gap, it indicates that the markets have to adjust to the new volatility. And adjusting towards a new volatility regime for the index takes some bit of more time. And then add to the fact that we've broken below the 25,500 mark, which I think could be maybe a short-term support for traders. If the index closes below those levels, it indicates that we are looking at the point where the index may start to open a downtrend, a trend on the downside. Add to the fact, the names like HDFC Bank, for example, and such other names. I think as I was looking on the chart, these stocks are at a 10-month weekly low in terms of closing basis. So that also I think could probably exacerbate the pain for the indices. So I think on the back of this, I would expect that next week, maybe not immediately on Monday, Tuesday, but I think for the remainder part of the next week, I think there could be a possibility that we may drift on the lower side.
Okay, so that's the